Well, let's go to the U.S. and talk to Larry Shover. He's joining us from SFG Alternatives in Chicago, and he is the Chief Investment Officer there. So, Larry, tell us, what are you watching on the markets right now?
Right now, I'm watching everything, and I'm just scratching my head. It's so full of discrepancies right now. When you figure that, European economic data continues to underwhelm. You look here in our shores, the Federal Reserve is really only the central bank that has any kind of stable policy right now. You have what's going on in Russia and Ukraine, and yet the S&Ps are at all-time highs. You have high yield and investment grade off its tights for the year. A lot of things just don't make sense. And then you have to add into the picture that oil is on its knees, as you said, a 4-year low. So a lot of things don't make sense. And boy, I'm just watching everything right now.
So how, as a chief investment officer, do you therefore position yourself when, even in your own estimation, things are not necessarily adding up?
Yeah, well, I have the benefit that we trade over 100 markets in 9 different countries, so we're very well diversified. But we look at short-term trend, long-term trend, and add them together. It just seems like what happens in an environment like now, where I think there's a lot of discrepancies, I would tend to pull back my exposure in the market because something just doesn't add up. And when you look at the equity market, my call for the end of the year was 2025 in the S&P 500. And I think anything above that is just fluff. And I think that the sledding between now and the end of the year is going to be a lot tougher than most people think.
Okay, let's talk then and break it down, because we do have earnings coming in quite strong. So as far as U.S. equity goes, I believe 79% of companies to report have beat earnings expectations, and that included Walmart on Thursday, your session that's still ongoing now. So how do you view earnings and how they fit into that picture?
Yeah, well, I'm very pleased with how the earnings, and also on the revenue side, they beat by 60-something%. It's been a big beat. The bar was set very low, so getting over that bar was pretty easy. And the way I look at it is that the U.S. right now is the locomotive for the global economy, and how much longer can that continue? I mean, who knows? I mean, they've been able to do this before. During the Asian currency crisis, Mexican peso devaluation, an off-cycle recession in Europe in the early 80s. It definitely has happened before, and it can happen again. But how long can the U.S. do this without seeing substantial growth from other parts of the world?
Well, I'm wondering how then this energy complex plays into that scenario, because we do have gasoline prices in the United States heading below $3 a gallon. So that's really positive for consumer sentiment, for spending in the U.S. And globally, if we continue to see these petroleum prices come off, and it doesn't look as if OPEC is blinking yet, and U.S. shale production can come on and off in a quick succession, responding to supply and demand and price, then the low oil price will inevitably be a positive for global economic growth, won't it?
Yeah, absolutely. It's going to keep inflation low, which we like, but obviously central banks don't like that right now. But yeah, that extra money is going to be spent, especially at a great time during the holidays. So yeah, the trickle-down effect is enormous. And the fact is, we have to remember that the strength of the dollar has something to do with this, has something to do with all the commodities that have gone down and just been out of favor. It's been more about supply overhang and a lot less about lack of demand. I mean, yeah, demand has been lumpy at best, especially in the products and the emerging markets. Yeah, it's been not so great, but it's a lot more about the supply overhang. So I have no problem, and I rightly think that Brent could be 70 by Christmas, and it could be $65 soon after that.
Talking about Europe, obviously that is a big risk for growth in the United States as well, global growth more predominantly.
Yeah.
And we do have that Eurozone GDP number out Friday morning. So what are you calling for that?
I think it's going to be consensus right in the middle. And, the GDP number in Europe, just like the GDP here in the U.S., people tend to look at it too much and decipher too much out of it. And I think the markets have already priced in consensus, and there's a range of acceptability. What's a lot more important for Europe right now is the PMI numbers, industrial production, those types of things. GDP obviously is important, but not as important as some people are making it out to be.
Okay, so you don't think that we'll see any sort of major market reaction to this GDP read in the United States in particular, or you believe in Europe sort of as well?
Yeah, no, I think both. I mean, as long as it's within the range of acceptability, and there's a pretty wide range, I think the market's going to look past that and is hinging on the fact that the ECB will do something to help the system there with financial repression, et cetera. So as long as it's within reason, I don't think anybody's going to care.
Okay, and how about the other risks out there? We still do have geopolitical tensions, as you mentioned earlier, bubbling between Russia and Ukraine. Yeah. How long or how bad would it have to get, I guess, for the markets to sit up and pay attention to that again? Because they're not.
Yeah, you know, that's a great question, and I've been scratching my head about that for 6 months, maybe even longer, like when oil prices were so much higher, and the market just wasn't properly assigning a risk premium to oil, but now I know why, because nothing has come to fruition, so maybe it's the same deal. The wheat market surely has been affected by it the last 2 days, coupled with the weather here. But there's a lot of geopolitical risks, and it just seems like it's stuffed in the back page of the newspaper, and nobody seemed to care. However, what we are seeing across asset classes is a small rise in implied volatility of the options. Nothing serious yet, but a lot higher than volatility was even 2 months ago. And that's probably pointing to the fact that people are starting to hedge their bets.
Okay, as far as what we're looking for to drive markets in the short term, we do have a couple of earnings reports after the close. Tell us, first of all, if any of those are really of great importance in your view. And B, I guess the economic data that we'll be looking forward to tomorrow, the retail sales, the consumer sentiment. I mean, what are you expecting there? And how important do you think that will be not only to markets, but to the U.S. dollar?
Yeah, you know, I think retail sales will be important because that underwhelmed last time in the U.S. However, people are looking at some of the mixed bag of retail earnings we've seen. So it's really a confusing picture. Now, consumer confidence, on the other hand, we had a really good number last time. So I think the momentum is building to see another breakthrough number, like a new expansionary high. With the U.S. dollar, the dollar's mixed today. Could definitely see the dollar snap back a little bit, but I think people are waiting for bigger things in retail sales to move the U.S. dollar one way or the other.
And that would be the U.S. Fed.
Yes, yes, yes.
Okay, so as we look towards 2015 then, I know that it's early, but around this time of year we start talking about end-of-year targets, which we've already covered, and of course looking forward to 2015. So how are you positioning yourself heading into the new year?
Yeah, well, definitely underweight duration in the U.S., just mainly because I think the ECB will do something which will just cause that carry trade to become negative. I'm not as short the euro-U.S. cross as I once was. I think it's become very, very overcrowded. Some of the industrial metals, I do believe there'll be some type of turnaround, especially when I look at steel, zinc, or iron ore. Copper, maybe not as much. When it comes to the gold trade, is very, very volatile, to say the least. And I do think that people are pushing it down for the wrong reasons. And short term in 2015, I think we could see a bounce higher.
Why do you think that we'll see a sort of rebound in some of the industrial metals, iron ore in particular, interesting to us in Australia?
Oh, I know it's, yeah, very interesting. And I was just in China a month ago and just seeing like how it's affected everybody. But the fact is the cost curve has been changing in all the industrial metals. I mean, it's a dynamic, fluid, it's a fluid thing. It's not something set in stone. So that has changed. The restocking of raw materials has slowed down, and that's going to have this lag effect. And I think we're just going to see more of a demand for the iron ore because of the lack of stuff in bonded warehouses and raw materials being imported into China.
Mm-hmm. Okay. Larry, we've got to leave it there. We're going to lose our line. Thanks for joining us.
Thank you.
Enjoy the rest of the session, the 15 minutes or so that's left.